public services, stability for our public finances, the single most important factor in getting the cost of living down, and economic growth, the best means to improve wages, create jobs, and support public services. That is what our plan, that is what this government and our Prime Minister are all about.
It's Thursday, the 27th of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the great China investment mystery. But first, it's Thanksgiving in the US, but it's also UK Budget Day +1. So I'm happily joined by Paul Dales and Ruth Gregory from our UK team to get a sense of how it landed and where the British economy is heading. Morning, guys.
Morning, David.
Good morning.
So the press response to Wednesday's budget statement, it seems pretty united from the left wing and from the right wing in just how bad this budget was in terms of boosting the economy, albeit with different prescriptions, different ideas on what Rachel Reeves should have announced. But what's really been notable for me is just how well the bond market has taken it all. I see gilt yields are up a little bit this morning, but we're basically back down to levels that we saw a few weeks ago before the whole budget mess kicked off. The fall in gilt yields since this announcement, is that a vote of confidence in the government, or is it just relief that the looming disaster that was being tracked in the press coverage leading up to the budget actually turned out to be averted on the day?
I think the gilt market's certainly, breathing a sigh of relief. So perhaps it's more of the latter, really. I think the relief rally seems to reflect a few factors. The first is the confirmation that the Chancellor will tighten fiscal policy by enough to keep the deficit on a downward track, and she'll increase her headroom or buffer against her fiscal mandate. Of course, it's one thing to promise a reduction in borrowing, another to actually achieve it. And I think we would treat some of the tax hikes, which are backloaded to just before the election in 2029, with some degree of scepticism. But even so, I think the big picture is that the budget provides some reassurance that the government remains committed to shoring up the public finances. And I think because the OBR was far more generous to the Chancellor than most had expected, this deficit reduction is being achieved with fewer tax hikes than expected. So if you look at the 26 billion of tax rises in 2029-30, that was still the third biggest rise in taxes in a fiscal event since 2010, but it was far smaller than the 30 to 40 billion that most had expected. So I think the budget did deliver less bad news than fears. And I think this will, in turn, help the Chancellor politically, reducing the near-term risk that she's replaced by a more left-wing Labour figure who's less committed to fiscal discipline. And I think there's another factor as well. The Debt Management Office accompanying gilt issuance plans indicated a reduction in the supply of new long-dated and inflation-linked gilts in favour of issuing more medium-term debt. And I suppose it's difficult to judge to what extent that had been anticipated by investors, but those types of gilts rallied the most yesterday, suggesting that was a positive surprise for the markets as well. So overall, I think it leaves us pretty comfortable with our view that the 10-year gilt yield perhaps will fall a bit further, from around 4.5% where we are now, perhaps to around 4.25% by the end of next year.
Yeah, we've got that report out a few weeks ago showing gilt yields as the highest among the G7, but that not lasting into 26. But it does sound, it sounds like we're in a better place than we were certainly a couple of weeks ago. And as you say, there is relief in the bond market, but we held this client briefing yesterday and were remarking on how this political pressure on the government, yes, it's lessened today, but fundamentally, it hasn't gone away. And I don't want to speculate on Rachel Reeves's future or Keir Starmer's for that matter, but just talk a bit more, Ruth, about the risks that we could get a less credible presence at the Treasury, if not at number 10, as far as the bond market's concerned.
Yes, I think you're right. This is a sort of a muddle-through budget, if you like, and it did achieve the two of its key aims, reassuring the markets, as we've already discussed. But it did also placate restive Labour MPs by raising taxes to pay for higher welfare spending, for example. So I think the Chancellor does appear to have, so far at least, come out of this sort of fraught fiscal process a bit stronger. And it has left, as far as we can tell, it has left lots of Labour MPs in a happier place. So that may offer a bit of reprieve for Reeves and for Starmer. Of course, as you say, the Chancellor still has to sell the budget to the public. It doesn't change the overall political picture, with both Starmer and Reeves experiencing historically low approval ratings in the polls. And I think the next obvious pitfall really is, provided the budget survives the political process over the coming days, I think that is the next obvious pitfall is the local elections next May, which could lead to renewed questions about the Prime Minister's position. And I think if Starmer and Reeves are at some point replaced by a new top team, I think it's perhaps hard to think of someone more fiscally constrained than Reeves. And so the risk is that this could spark a gilt sterling sell-off, as was the case back in July when there were rumours that Reeves might be removed from her post.
Okay, Paul, let me ask you, I mean, Ruth described it as a muddling through budget. The fact is that spending has been increased. The fact is that taxes have been increased by much more. But everyone's still sitting around wondering exactly what this government's plan is for boosting growth above pretty anaemic levels. Is that a fair assessment?
Yeah, there is quite a lot of confusion around it. I think the government has actually been quite clear on its plan, or it certainly was after it was elected. Reeves went out of her way to say that the aim was growth, growth, growth. And the way they wanted to achieve that was investment, 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 essentially. They boosted public investment in the first budget just over a year ago. They've put in place plans to ungum the housing market to boost home building. And the idea is that that will spill over into bigger increases in business investment as well. So there is a plan. They're just not being able to deliver it, though. This is the real problem. There's been almost no improvement in home building, and we haven't seen the fruits of any increases in public investment as of yet. And their other policies have really stifled business investment, such as the big whopping increases in taxes for businesses in the first budget a year ago. So the plan's there, but it's just not being delivered, and other policies are actually working against it. Just one more thing on that. There's a bit of this yesterday, actually, in the budget as well, because if you want more investment, you need more savings to pay for it. But yet the Chancellor announced a reduction in the tax benefits for investing in pensions through salary sacrifice schemes, and also a cap on ISAs for £12,000 a year, which both disincentivise saving. So there is this plan, but some of the policies, they're not all singing together and moving in the right direction. So some of it's just not very coherent.
Rachel Reeves was celebrating the OBR's GDP growth forecast upgrade yesterday, I think to 1.5%. It doesn't sound like very much. How does that sit against the UK's potential growth rate and our own expectations?
Well, I mean, Reeves has got to choose anything that's going in her favour at the moment. And it's actually in line with our forecast for economic growth this year, 1.5%. But what's happened is that growth has very much been quite strong in the first half of the year, when a lot of activity was brought forward ahead of Trump's tariffs coming in and some UK tax rises as well. But it's almost stalled in the second half of the year. So it looks a lot better than it really is. We do actually think that the UK's economic potential growth rate is about 1.5%. So on that measure, we're kind of cruising at the right rate, but it's that annual rate isn't really telling you what's going on. I mean, the economy hasn't really grown much at all in the second half of the year. The annual figures are flattering.
Are we just in a 1.5% growth world? Do you see anything that would, because you say that's the potential growth rate, it doesn't feel, living in the UK, it doesn't feel very strong. It doesn't feel very good. Is there anything, I mean, how do we get out of this pace of growth?
Well, the government's reforms or the government's plans that it's had put in place and is still pursuing in theory, could make quite a big difference. We've done quite a lot of work on this, and we estimated that it could boost the UK's medium-term growth rate by something like 0.4 percentage points. So if you're traveling at 1.4% each year, if you can then raise that to 1.9% each year, that's a really, really big deal. But as we've discussed, that they're just not able to deliver on that. That's a theoretical boost that just isn't happening in reality. I think what's going to happen here is actually it's going to be maybe the behavior of businesses that come to the rescue rather than the government. We've been quite positive on the outlook for artificial intelligence and the possibility that it will boost productivity growth in most major economies. We've been saying that for the past 3 years. We're seeing signs of that perhaps happening in the US. And we think actually the UK is one of those economies that might benefit by more than many others. We established that using our proprietary Capital Economics Artificial Intelligence Economic Impact Index, which of course, as you know, is CEAIEII for short. And that suggested that the UK is actually the third well-placed economy of all the major economies to benefit from AI, because it's got a really big services sector, it's got flexible labour market, it's got light regulation, and it's got a history of innovation and adapting to technological change.
As you say, the US team sees the benefits of AI on productivity in that economy. They're seeing the signs of that happening now. How much of a lag do you think there will be in terms of when the UK will start to see these benefits, or are we seeing anything now?
There's not huge amounts of evidence in the data itself as of yet in the UK. So it was always going to be the case, and it always made sense that the UK and every other major economy is going to lag behind the US here. The US is at the technical frontier, it's pushing the boundaries, and it tends to do these things first. So there's not that much evidence as of yet it's boosting the economy. For what it's worth, we have penciled in a quite chunky boost in productivity growth in the UK starting in the 2030s. And building to the UK's economic potential growth rate rising from 1.5 to about 2% in that decade. So we think the fruits of the AI revolution will start to be felt early in the 2030s. It's possible it'll come a little bit sooner, but will just remains to be seen really whether that is the case. But it feels like there is going to be a benefit. It's just a question of when it happens and how big it's going to be.
And until we get there, we've got these debates about public finances, don't we? We've been talking in the office about the extent to which developed market governments, and not just the UK, governments across the advanced economies have struggled to provide standards of living that have been enjoyed by sort of post-Second World War generations through the 1990s as interest rates rise, as the world becomes more fractured, as populations get older, and it feels like you're watching a battle over who gets what slice of the pie or how big the slice is. And there doesn't seem to be, AI predictions aside, there doesn't seem to be an answer to that. Simply, governments cannot afford to provide those standards of living anymore. So sacrifices have to be made. And the question comes down to which constituency gets harmed the most. So is that a process that you see getting more challenging as we go forward?
I think so, yes. So the really big changes are that defense spending now has to be higher than it was over pretty much the last 20 or 30 years. And interest rates are higher and are likely to stay higher than they have been over the last at least decade, if not a little bit longer. So in some ways, these trends have been building for a while, but they've been hidden or masked or offset by those temporary benefits of lower defense spending and lower interest rates. Now, I think there's some temporary benefits coming further down the line. Earlier on, Ruth mentioned that we think gilt yields are going to fall in the UK because we think bank rate in the UK is going to fall a bit further than most people expect. So that will relieve some of the pressure with interest rates coming back down, but interest rates aren't going to go back down to the near zero rates. So do need to get used to the idea that governments are going to have to pay a higher interest rate bill than they have done for a long time. The issue then becomes, as you quite rightly say, is that there just has to be a debate about how high government spending should be and also who gets what. That debate doesn't seem to be happening seriously at the moment, and it's something that does need to be addressed. The way out, I guess, is probably more restraints on government spending to some degree, but hopefully economic growth can accelerate and come to the rescue here. And as we've discussed, we think artificial intelligence is the way that could happen, or is the most likely way that could happen, rather than governments actually making too much difference themselves.
Yeah, I described it as slices of the pie, but I guess if you grow the pie, the debate gets much easier.
Yeah, exactly. I always think about it in terms of personal finances. If you have spending pressures, then you've got two choices. You either spend less, or you try and get more income. And that's essentially the same thing. More GDP is the higher income.
I don't know what it says that I think about it in terms of pies, but we'll leave that conversation for another time. Paul Dales and Ruth Gregory speaking about the UK budget. I will add their analysis to the podcast notes, as well as a link to a drop-in. That's one of our short-form online briefings that we are holding next Wednesday on the budget's implications for commercial property in the UK. That drop-in follows our briefing yesterday, just after the Chancellor's statement, in which the team gave their immediate take on what it means for the UK macro and markets. I will add a link to that recording to the notes as well. Paul also mentioned the Capital Economics AI Economic Impact Index, the catchily named AIEII, which has the UK placed number 3rd. This is a proprietary measure of how well positioned the major economies are to develop AI, to diffuse AI, to benefit from AI's rollout. We refresh it at the start of every year, so look out for the latest version of that in early January. It is part of our large and growing body of analysis on exactly how this technology is going to transform the global economy and financial markets. Now, a debate has kicked off among China economy watchers in recent weeks following official data that shows a notable fall in the monthly fixed asset investment numbers. It's one of the most closely watched official data series because China's is an economy that is still overly reliant on investment to deliver growth. Arguments for why investment has dropped so much has centered on the government's so-called anti-involution campaign, which is Beijing's attempt to try to end brutal price wars by tackling overcapacity in the industrial base. I spoke to Leah Fahy from our China team earlier this week all about this issue. I started by asking her what's been going on with the investment numbers.
Yeah, so it's obviously a question that has been bugging a lot of economists and analysts recently, because what we've seen is in the past few months an absolute collapse in fixed investment in China. So in October, overall fixed investment falling almost 10% year on year in comparison to, been growing kind of at firmly positive around about 5%, slightly below that year on year rates for the past few years or so. And that's quite reasonably led a lot of people to ask why, what's going on, what could possibly be prompting such a collapse in investment in an economy that's so dependent on investment for growth. Now, I think the thing that people have been jumping to immediately is the fact that it could be the result of the government's new anti-involution campaign, so its efforts to crack down on China's overcapacity issue. So that was launched earlier this year, and it essentially aims to decrease kind of the total amount of capacity in China's economy, bring kind of supply and demand back into line. And I think people have been looking at this drop as a sign that maybe that's starting to bear fruit. Now, I'd caution against that optimism, unfortunately. So when you kind of dig down into the data, into a little bit more detail, there's a few interesting things that pop out. So one point I think that is quite striking is that if you break out this investment data by province, there's a really strong correlation between the provinces that had pretty severe weather-related issues this summer, so flooding and heat waves, and the provinces that have seen the sharpest falls in fixed investment. So that suggests that there could be something weather-related going on. It's not there's actually a fall in planned investment or desired fixed investment, but there's had to be some delays to things like construction because of these weather-related issues. Now, obviously, this fall in fixed investment has persisted into October. We've seen most of the kind of summer of the weather-related issues start to die out. So I think it's unlikely that's the only explanation. The other interesting thing is if you look at fixed investment by sector, it's not just the manufacturing industry that's seen this sharp decline in fixed investment. You've also seen it in infrastructure investment and real estate investment. So again, not obvious that it's necessarily this anti-involution campaign. And the other point worth highlighting is if you look kind of more detailed into the manufacturing sector, which sectors within that have seen the sharpest falls in fixed investment, there isn't any sort of obvious correlation between the sectors that have bigger overcapacity issues and those that have seen the biggest falls in investment. It's quite broad-based. So this all makes us think that it's probably a series of idiosyncratic factors that are causing this sharp decline in investment rather than a clear sign that China's overcapacity issues on the mend.
I mean, if we were seeing a collapse in investment, would we not see that in other indicators of the economy? What does the rest of the economy look like, even as we're seeing fixed asset investment fall so sharply?
Yeah, so this is the interesting question, and it comes back to what figures do you trust and which ones do you think give a good picture of the economy? Fixed investment is one that a lot of people look to give them an idea of what's going on in industry in China. We've had our doubts about the accuracy of Chinese official data for some time now. So we have kind of our alternative China Activity Proxy, which is our in-house measure of what's really going on in China's economy. And we break that down by sector as well. So we have the service sector, industrial sector, and construction as well. And so if we look at the most recent reading for October, which is obviously the month where the decline in fixed investment has been sharpest, we have seen a slowdown in growth kind of at the high level. So China's economy growing at around 3%, which is much weaker than official statistics. But I think the point to highlight is that, I mean, when you look at that breakdown, industrial activity is still growing at a pretty decent clip, which stands in pretty stark contrast to fixed investment in manufacturing and in infrastructure, which is declining in year-on-year terms on official statistics. And it's really not obvious that this collapse in fixed investment is translating into any reading on our China Activity Proxy. So all this suggests that it's probably something going on in the data rather than kind of a reflection of what's actually going on in the economy. In terms of what that could be, there's often changes in how things like fixed investment are actually measured officially in China. And it's possible that there's been a decision to change some sort of accounting method even that has happened to coincide with the start of this anti-involution campaign, potentially intentionally, because then it looks like there has been a sharp slowdown in investment, which obviously is in line with what the central government wants to be happening right now. But at the same time, you could see it wouldn't be surprising if local governments are kind of massaging their fixed investment figures, again, to look like they're complying with the central government's campaign. But yeah, I think the interesting thing is that the data that we're seeing, the kind of lower profile activity data, doesn't chime with this sharp slowdown in fixed investment that we've been seeing.
Okay, so just to be clear, so it could be it's weather-related disruptions. Maybe you've got these zealous local officials who are just reporting numbers to Beijing to follow Xi Jinping's policy directives, or it could be tied in with methodological changes to the fixed asset investment series. But what's quite clear isn't happening is that there is actually a physical collapse of investment in China.
Yeah.
So based on all of those factors, what is the outlook for investment and what's the outlook more broadly for the economy?
Yeah. So if we're thinking about just kind of this high level fixed investment series, which, as I said, might not actually be reflective of what's going on, we should see this sharp downturn kind of reverse before long idiosyncratic factors washing out. And similarly, kind of, eventually, even if officials are underreporting, the impact that'll have on the overall series will start to wane as well when you get kind of base effects feeding through. At the high level, what it means for investment in China, look, we have obviously seen from the central government efforts to crack down on overcapacity, boost consumption over investment, and try and take steps to rebalance the economy. But I think at the high level, it still looks likely that investment, particularly manufacturing investment, is going to remain a key priority. So we've heard out of plans for this upcoming 5-year plan, which is going to go from 2026 to 2030. The self-sufficiency and technological leadership are still the key priorities of the government. And what's needed to achieve that is essentially high levels of investment in manufacturing. There's going to be continued efforts to boost consumption. We've had consumption plan outlined this week. There's been a series of small but not insignificant consumption boosting measures implemented by the government, childcare subsidies, this consumer loan, this consumer goods trading scheme, and so on. But yeah, as I said, I think the big picture is that investment is still going to remain the top priority. And consumption is really second to that.
And deflation will remain in train then.
Yeah, as a result, you're going to have this continued imbalance between supply and demand, which ultimately means that deflation remains an issue at least through next year.
Leah Fahy on China's investment mystery and our China Activity Proxy. The latest monthly reading of the CAP is just out, and it presents data showing why this might not be an actual investment slump, as well as more evidence that shows that overall economic growth in China just isn't as strong as the government says it is. I will link to that report in the podcast notes. Do check that out. The underlying data is available to Capital Economics subscribers, so get in touch, sales@capitaleconomics.com if you want to get the CAP, if you want to get all of our written analysis, access to all of our drop-ins, our data tools, and much more besides. But that's it for this week. We will be back next week with more from the world of global macro and markets. Until then, goodbye.